Your entire real estate portfolio is at risk if you ignore migration data. While everyone chases headlines in Austin or Miami, the real money is hiding in a specific cluster of mid sized cities experiencing a quiet population surge that most investors completely overlook. Today, I am pulling the curtain back on the three cities poised for the highest long term appreciation, starting with a specific metric that guarantees future demand. Population growth is the heartbeat of real estate. If you follow the people, you follow the money. It sounds simple, but most people confuse raw numbers with growth rates. A city that grows by 50,000 people is not always a better investment than one that grows by 10,000, depending on the starting size of that base. You have to understand the velocity of change. First, let's talk about the low hanging fruit. This is your accessible, immediate win strategy. It is all about the migration shift to what economists call the Sun Belt. Think about Austin, Texas, or Charlotte, North Carolina. These aren't just trendy spots on a map. They represent a massive structural shift in how Americans decide where to live. Between the years of 2010 and 2020, Austin's population grew by over 30%. When you see that kind of growth, the demand for housing is essentially guaranteed for a decade. A friend of mine bought a small rental property in the suburbs of Charlotte back in 2015. At the time, it was just a quiet neighborhood. But because of the steady influx of corporate headquarters moving to that region, banks and tech firms specifically, her property value has nearly doubled in less than 10 years. The logic here is bulletproof. When businesses move, they bring high paying jobs. When high paying jobs arrive, people move to fill them. When people move, they need somewhere to live. It's the most reliable engine for real estate growth you can find. Start by looking for state capitals or major metro hubs in the South where the cost of living is still under the national average, but the job market is expanding. Okay, so that works great for steady, predictable returns. But what if you wanted to level up? This second method requires looking at the satellite city effect. This is where you avoid the massive metros that are already overcrowded and instead target the secondary cities within a 45-minute drive of a massive, booming tech hub. Why does this matter? Because as large cities like San Francisco or Seattle become unaffordable, the workforce doesn't just disappear, they migrate outward. Consider the data from the Bureau of Labor Statistics. In the last 5 years, remote and hybrid work models have completely changed the map. We have seen significant population spikes in exurbs that were once considered nothing more than farm towns or sleepy residential enclaves. A study by the National Association of Realtors found that areas within that 45-minute commuting radius of primary job centers are seeing property appreciation rates 15% higher than the core city itself. Think of it as a ripple effect. When a rock drops in the water, the primary city, the waves move outward. If you own the land where those waves hit, you win. It's a higher level play because it requires you to look at commute times, infrastructure projects like new light rail extensions, and school district ratings. If you're finding this helpful, hit subscribe. I drop these breakdowns every single week, and I want to make sure you don't miss the next one. Now, ready for the one I've been saving for you? This is the third method, and it is the secret that separates the top 1% of real estate investors from everyone else. Forget total population counts. Forget migration stats. You need to track the prime age workforce growth. Here is the reality. If a city is growing because of retirees, your rental market might be stable, but your appreciation will be slow. Retirees typically live on fixed incomes and they don't drive economic expansion. But if a city is growing because of people between the ages of 25 and 44, that is the sweet spot. That specific demographic is at the height of their earning potential. They are starting families. They are looking to upgrade from apartments to single family homes. They have the most consistent demand for high quality housing. I saw this happen in real time in places like Boise, Idaho, and Huntsville, Alabama. These cities didn't just grow. They specifically attracted a massive influx of tech literate prime age professionals. That is the specific metric that determines long term wealth. If you find a city where the total population growth rate is high, but the prime age workforce growth rate is faster, you have found a gold mine. It's easy to get distracted by flashy city headlines, but once you look at the demographic breakdown, the picture becomes clear. You aren't just betting on a location, you're betting on the people who will actually afford to buy the houses there in 5, 10, or 15 years. Let that sink in for a moment. Most people buy in a city because they hear it's hot, but the investors who actually build generational wealth are checking the age brackets of the new residents moving in. They are looking for high earning, high growth potential. So there you go. 3 ways to master real estate investment through population metrics. The first is the Sunbelt expansion. The second is the satellite city ripple effect. And the third, that prime age workforce tracking. is the one that will fundamentally change how you analyze every market you look at from here on out. Once you see it this way, you can't unsee it. You will start looking at census data, migration patterns, and local economic development reports through a completely different lens. If you got value from this, please share it with someone who is currently looking for their first investment property. It might save them years of trial and error. Subscribe so you don't miss the next deep dive into market analysis. Next week, I am breaking down how to analyze property tax trends versus school district quality to predict the next big neighborhood flip. I'll see you in the next one.